Hello, everyone. I'm Brittany Button, long-term care insurance specialist for Art Jeter and Company. Today, we have Larry Moore with National Guardian Life joining us. Now, we're here to discuss a very common question, which is, should I insure or should I self-fund? Now, I'm biased, and the answer is insurance. However, Larry is going to take a more objective approach to this question and discuss the pros and cons of each strategy. At the end of the session, we want to answer any and all of your questions you may have, so simply type those in the questions or chat box in this presentation. With that, Larry, let's get started.
All right. Hey, good afternoon, everybody. And Brittany, thanks for having me. I'm just going to warn everybody right now, I am actually at an airport. So my signal can get a little fluky, and from time to time it may freeze up, and just letting you know that that's the challenge we have here. But meanwhile, I think everything is working just fine. So that's exactly what we're going to talk about today. You know, you have clients who out there actually believe or have been told that they can self-fund this risk. And I will tell you, there's really no wrong answer at the end of the day. If somebody is convinced in their mind that they're going to self-fund, don't tell them they're wrong, but you tell them that's certainly an option. The question is, what are the impacts of leveraging insurance versus choosing to be the insurance company yourself? That's really what we're talking about. And that's the goal of this presentation, because what I have found is a lot of agents have sometimes a tough time articulating the value of insurance unless they can really show, bottom line, what are the numbers? And once you see the numbers, it's awfully hard to argue against insurance. So let's just get started right away. So like Brittany said, Brittany, you should see, I'm on the objective slide. Do you see that one?
We are good to go.
All right. So I thought I'd take a stab at this just to be truly as even-handed as I can. And then this will probably help you with your clients as well when they're either on the fence or absolutely convinced in their mind they want to be the insurance company. So we are going to compare both the pros and the cons of self-funding or leveraging LTC, right? And there truly are pros and cons to both. I can't argue that. And then I back it up with a couple of numerical scenarios that will do a nice job of contrasting and level setting where the argument really ultimately winds up. So let's start with the pros of self-funding versus the pros of leveraging insurance. So looking on the left side here, the idea of self-funding comes from the idea that you want control, right? And if you have the ability to pay for what you want, where you want, when you want it, that has some appeal to it. It's also used as an excuse not to plan. But the bottom line, on the self-funding side of the equation, true, it's easy. There is no barrier to entry. You don't have to go through underwriting to self-fund. The money theoretically is in hand. And as I mentioned earlier, you have full control of that money, right? You still have an asset if care is ever needed, but if care is not needed, you still retain that asset. As I mentioned earlier also, you pay for whatever you want, whoever you want, whenever you want, right? You have complete freedom. And then at the end of time, you don't need to file a claim. You just call your advisor and start liquidating your accounts and paying taxes and all that good stuff. But that's the upside to the self-funding side. Basically, you take no action. It's easy. It's simple, right? The problem is it's short-sighted. So when we move to the right side of this page, you'll have superior purchasing power with insurance, taking pennies to dollars. That's how I like to put it. You simply cannot, well, unless you're extremely wealthy, it's really difficult to match the leverage you get with insurance if you're going to self-fund. You simply cannot. In other words, you make a small investment, we'll call that an annual premium, to incrementally fund a strategy that day one will give you significantly more purchasing power than if you were to be the insurance company yourself, right? There's also attractive tax treatment to tax-qualified long-term care insurance. IRS code 7702B gives us a lot of upside when it comes to the tax treatment of the benefits. Of course, they're not taxable, not considered income. As you know, when you liquidate investments, what do you pay? If there's gains, you're going to pay taxes on those gains. You're also going to pay, what I call transportation fees, commissions, whatever it costs to get that investment liquidated, right? But the tax treatment of LTC benefits very attractive. Businesses also enjoy a unique tax status under IRC 7702B. Either part of or all of the premium can be written off, basically as a business expense. And then at the same time, you'll enjoy tax-free benefits as well, double tax-free benefits. Kind of a nice deal, right? And then at the end of the day, what's great about Art Jetter is they give you access to the entire marketplace. So if you have somebody who really can't get off the self-funding idea, there are asset-based products out there, basically life-linked or annuity-linked benefits to LTC that give you guaranteed premiums and also give you the ability to recapture that investment if you never use it. So in a sense, you still have control over that asset. The reality is, though, getting your money back means the opportunity cost was that you never had a chance to invest that money. But anyway, that's kind of both the pros and the pros, I should say, of both strategies. And as there's always an upside, of course, there's a downside. And we're going to take a look at that next. So did that page switch over, Brittany?
Yes.
Perfect. Okay, so what's the downside to either strategy? Again, starting on the left side, you've got money in hand that you, out of good faith, set aside if you ever needed care in your older years. Well, guess what? The risk that money faces, aside from market risk, is you. Your priorities could change. Suddenly you may decide, there's that boat I've always wanted, or let's go buy our vacation home, or let's help the kids in college, or whatever it might be. Changing priorities with your money, or there could be financial hardship, would force you very quickly to move that money to a different purpose. And then all of a sudden your LTC strategy is blown out the water. I alluded to this: exposure to market risk or interest rate risk. Your investments will fluctuate in value. And, when you think about what happened to the markets in 2008, God, I hope we don't go through that again. What an awful time if somebody had to liquidate their accounts when they're worth half of what they were the day before. Right? When you liquidate an investment, aside from the cost of the distributions themselves, premiums and fees and whatnot, it's generally a taxable event too. So you're going to pay tax on that money. And I think the best real life example I can think of is when my grandfather lived with us. He needed $12,000 a month. We had to liquidate $14,000 a month to cover taxes and fees, right? So you actually exacerbate the liquidation or the winding down of that asset just through taxes and fees. At the end of the day, people generally will underfund the actual cost of care. Now, if you're setting aside a couple $100,000, they say, wow, that's a lot of money. Well, when you look at what insurance can deliver, you realize I'm not even close to being able to honestly self-fund this adequately. So typically people underfund or underestimate what the cost of self-funding would look like. And then ultimately at the end of the day, when you're going to self-fund, the question is, at the end of time, with your investments, what did you really want to do with that money? What did you want your legacy to be? Because if you self-funded and then you decide, you reach a point where care is needed, you start liquidating, that's one spouse or partner start liquidating. If there's a second person and then they need care, you basically compromise your objectives at the end of the day with legacy really mean, because you are then forcibly deconstructing your planning. Right? So that's the downside of self-funding. And when we look at leveraging insurance, the downsides are pretty straightforward. There's a barrier to entry called underwriting. Not everybody can buy this strategy. That's why you want to get it as young as you possibly can. If care is never needed, in the case of traditional long-term care insurance, it's use it or lose it. Now, traditional long-term care insurance does afford you superior leverage because it's really a pure risk strategy versus the asset-based products we have. But it's a use it or lose it scenario. Also, there is the risk that these products could go up in price. Right? They're not guaranteed unless you look at, for instance, NGL does have a guaranteed 10-pay, but on the traditional side, there are no guarantees. Right? Now, saying that, the new assumptions that they've been using for the last 8 to 10 years have proven pretty stable because they're very, very conservative. So we really may, in many respects, be beyond that reality of having to raise rates all the time, and that's good news. Um, these contracts, as I say in the fourth bullet here, are for the most part illiquid vehicles, meaning they're designed for one purpose, and that's to pay for long-term care. So when we look at asset-based products, again, that's a fancy way of talking about hybrids or life-linked or annuity-linked products. People think, well, maybe I could borrow against those contracts like I can any life insurance policy. And the answer is if you do that, that's great, but then you will totally crash the product. The cash values in hybrid LTC products is very thin. And then finally, when it comes time to get your money, you're going to have to file a claim. So you need a plan of care drafted. And then that plan of care with your doctor's certification will follow an assessment, and then you can get your money. So you do have to undergo a process to secure the money. So those are the two upside, downside realities of this strategy. And I think if you look at it from that point, and if it comes up in an argument, you never want to tell the client they're wrong. You always tell them, well, that's certainly an option. You can do that. Let me help you kind of see the light in terms of the upside and the downside of each strategy, right? So going from there, we're going to look at a couple of scenarios here. I'm using a 57-year-old couple, Nebraska rates, which are really our national rates. The only place we have unique rates for the carrier's perspectives tend to be California and New York, if you even have a carrier there. Florida rates are different, but for the most part, our national rates are what Nebraska rates are. And here's a scenario I want to paint for you. This couple could buy a traditional long-term care policy with a shared benefit. And let's just suppose that it's a $200 a day benefit with a 3% guaranteed growth rate or compound inflation rider and a 90-day waiting period, elimination period. And that it is, of course, comprehensive coverage. And the premium that this couple would pay for that strategy over 30 years would ultimately wind up costing $200,640. So over 30 years of premium payments on an annual basis, the outlay would have been $200,640. Right? So keep that number in mind, and let me share with you the two scenarios I'm going to kind of put forth here. The first scenario on the self-funding side is, well, if that's how much money I'm going to spend over 30 years, why wouldn't we just invest that money and, over a 30-year period of time with a growth rate of 5% pre-tax? Pretty conservative, safe bet that that's not going to be, we're not blowing the socks off it, but that's one choice. Let's just take whatever the premium outlay would be and invest it. Okay? The second scenario will be, okay, if I just invest the premiums, looks like my connection may be lost. I'm just going to back out here real quick, and it looks like that is the case. So I'm just going to reestablish it. And I think we'll be good in a few minutes here. Okay, I'm going to go back to, am I back in the slide mode, Brittany?
Well, we didn't see it switch over to the edit mode, so give it a try to switch the slide.
Yeah, how's that? You see it moving now?
No, unfortunately not.
Okay, let me just do this real quick. I think it's just reconnecting here. Okay, it looks like we are reconnecting, folks. Sorry about that. Okay, we should be good. Let me do this. And I'm doing a quick movement here. Does it move?
No movement yet, unfortunately, Larry.
Okay. I think it says it's been reestablished, so I'll finish my explanation, and then hopefully we can make this thing move here. So the second scenario then, since I know just investing that premium amount won't get us nearly close enough to funding the cost of care or what the insurance would do performance-wise, how much would it take at a growth rate over 30 years at a 5% pre-tax rate of return, right? So fingers crossed. We're going to flip to the next page. Did it go?
It did not. It does show it's in presentation mode, Larry, or in editing mode instead of presentation mode, but it has not switched over yet.
Okay, that's interesting because I do have connection now. So yeah, so it should go. I wonder if we should pull up your presentation. I don't know.
I was going to say, Larry, if you'd like, I have the presentation up. I can definitely drive for you if you just let me know when to switch slides.
Why don't we do that? Because it should have come up by now, but it looks like the signal hasn't reached WebEx or the GoToMeeting yet.
All right. So, again, apologies, folks. You gotta love technology, so just give us one moment as we switch presentations here. All right. So, Larry, are you seeing my movement?
Not yet. So let me see. There. Oh, I don't see your movement yet. Let me. Oh wait, here we go.
Hi, Larry. Are you still there? Oh, boy. All right, folks. Apologies on this. Again, we're having some technical difficulties. We'll wait a few moments. Worst case scenario, if we can't get Larry back on board, I will reschedule with him. We will record this presentation and get that replay link sent out to y'all. Again, we'll just give Larry a few moments to see if he can get reconnected. Stand by. All right, folks, again, apologies for the technical difficulties. Looks like Larry is trying to pop back on, so we're just going to give it about another minute or two, see if he can get back up and running. If not, again, we'll get a recording out to y'all with a clean presentation. Stand by.
Hello?
Larry, do we have you back?
I am back. So, boy, that was quick. I lost not only my connectivity, but my phone dropped me too. So, okay. So sorry about that.
Good news, we didn't lose anybody, so we still have the full audience here. Are you able to see my screen with your slide deck on it?
Let's see. I think I do. So let me, where we should be, it's funny. It's an elusive creature here. I don't know what happened. Hang on a second. Otherwise, I think what I'm going to do is I know exactly where it was. I'll just run my presentation and you run your page. How's that sound? Although, here we go. I think I see it. Okay, so are you looking at plan design scenario, 57-year-old couple with the little image there?
Yes.
Okay, awesome. Okay. So here
All
we
right,
go.
so folks, Larry's still going to present. I'm going to drive, so Larry, just let me know when we need these slides changed, and let's take it away.
You got it. Okay, so I pretty much laid out the two choices. Do we invest the ultimate premium outlay and see where we wind up? And we chose a 30-year window with a 5% pre-tax growth rate. We're going to compare that to, well, if we fall short, what would it take? So this gives you a sense of where we're starting with insurance, right? You're going to pay, in this couple, for instance, they're going to make an annual investment. I'll call that the premium of $6,688. Right? And by making that one premium payment day one, they have at their disposal $657,000 of tax-free liquidity day one. Day one. And keep in mind that the original premium outlay was $200,000. Well, guess what? Day one in this strategy, you've got $657,000. So big difference right there. Let's go to the next page. So this is kind of a compare and contrast of the two strategies from day one and then over time. Okay. So when we look at year one, day one, they make that initial premium payment on the left side, $66.88. They have day one at $657,000 to use if something happened that day. Meanwhile, go to the right where we make our initial investment. We reposition $200,640. Day one, that's all I got. And if you had to claim on that early, you're going to wipe it out pretty quickly. And when we look at that, and we know that $200,640 that I've repositioned is going to grow at a pre-tax rate of 5%, compounding. After, say, year 30, right, when I made that premium outlay on the left side of $200,644, I no longer have $657,000. I've got almost $1.6 million in tax-free liquidity. Taking it all the way to the right, my self-funding strategy, I'd have $870,984. Now that sounds pretty attractive, but keep in mind that guess what? I'm going to pay tax on that when I take those distributions out. So actually, I probably need quite a bit more. So the answer to this riddle right here, well, if I were to do this, investing just the premium outlay probably won't be enough. So let's look at scenarios. In fact, we'll take it to the next page so you see what the real shortfall is at the end of the day. And there you go. So when we look at scenario one, the insurance would have given us just short of $1.6 million after the 30th year. Meanwhile, if we invested the $200,640, we're short $723,017. That's our shortfall. So that's quite a ways off. So how do we remedy that? Well, the question is, how much would I have to set aside to match the performance of this insurance vehicle over 30 years? So let's go to the next slide. And here you go. You already know what the first side looks like, right? In this case, to match the insurance, I would have to set aside $368,000 if I'm going to use that 5% pre-tax growth rate. And even at that day one, I'm significantly short. In fact, as I go down this, even after 10 years, I'm still quite a ways off. Even with setting aside a significantly greater amount of money. By the time we get to year 30, the self-funding strategy, provided I didn't touch it or interfere with it at all, that's pretty much caught with the insurance strategy. And if we look at the next page, you'll see that ultimately we weren't really too far off with this play, $397 difference. So basically it's a wash, but I'm also not taking into account taxation, and that's going to be the big impact. I would need a good deal more just to basically address the taxation of it and the costs of my distribution, along with market risk and a whole lot of other factors. There's no guarantee I'll wind up with enough, even if I set aside a significant amount of money like that. And here's what's important to think about too. By setting aside or repositioning such a huge amount of money for a single purpose, that really makes me pretty much illiquid in a lot of other ways. It takes a lot of flexibility out of my hands because I've committed all that money to one purpose, right? So at the end of the day, when we go to the next slide, this will pretty much kind of, it brings us to the end, pretty much summarizes what we're trying to show you here. Is at the end of the day, both strategies have their merits and they have their demerits, if you will. But at the end of time, the question is efficiency of capital, and you can't beat the efficiency of capital when it comes to funding insurance. And Brittany, that is the message for today on the idea of whether you buy insurance or not.
All right. Well, first and foremost, thank you, everyone on the call, for sticking with us during our technical difficulties. Greatly appreciate it. And of course, even we appreciate you taking the time out of your day to listen to us chat about long-term care insurance for a little bit. Larry, of course, thank you for taking time during your travel schedule to present to us. So for folks out there, if you have questions regarding long-term care planning, insurance solutions, and would like to have a one-on-one discussion, please feel free to reach out to our team. Numbers shown here at 800-228-0008, or shoot us an email. We can be reached at ltci@jetter.com. So I hope everyone enjoys the rest of your day. Again, thank you for joining us, and have a good afternoon.
All right, Brittany, thanks a lot. Appreciate you having me.